we call this panel Show Us the Money. I don't know how many of you have seen the movie Jerry Maguire, Tom Cruise, one of his best roles, I think. And I don't know how many of you have had people screaming at you in the phone, show me the money. But anyways, we'll get to that, I guess. I thought we could start with a short round of introductions, and I would like you guys to introduce yourselves. I think you're best at that. And why don't you just say a few who you are, a little bit about the fund you're representing, and perhaps also tell us what was the most recent Swedish company you invested in. How about you, Farzad?
Right, so I'm Farzad Abdi-Dezfuli. I'm actually the founding partner at Sarsia. I'm a pharmacologist by training. I've basically done the whole academic round. I was in pharma. I was part of the strategic Nordic group in Lilly, worked in the US and in the Nordics before going to VC, finding Sarsia in 2006. We're actually currently working on our fourth fund, which we've called the Innovative Medicines Fund. In terms of Swedish cases, actually Coegan Pharma is one that I think we were one of the, in any case, the core founders in a way for the company. Yeah, so that's pretty much me.
Check. One Swedish company invested. Great, thank you. Christer, what about you?
Yes, so Christopher.
You need to use the microphone, sorry.
So I think I'm. Yeah. Is it working?
Okay, yes. Great. Oh, yes.
Yeah. So my background is in research and entrepreneurship the last 30 years, actually. 30 years since I started CellaVision, my first company. Our fund is focusing broadly across all sectors. Among those, actually some deep tech, but mainly in life science. And most life science is actually slightly outside of sort of traditional pharma deals. We'll probably talk about that later. Our latest investments, we are looking at in Lund, actually. We have a fund of around, well, close to 100 million euro in 2 funds. And our latest investment was Din Psykolog, which is a local company, I believe. Yeah.
Great. Shamim.
Shamim, associate at HealthCap. We're a Swedish-based life science venture capital firm, currently investing from our 9th fund, so we've been around for quite some time now. Have a precision medicine focus, agnostic to therapeutic areas, agnostic to modalities, but we're very scientifically driven in sort of our investment hypothesis. Personally, I'm a medic by training, so MD PhD here from Stockholm. Co-founded and sold a small company before I joined HealthCap a year and a half ago.
Thank you. Did you mention any Swedish companies you invested in?
That's very true. So our last investment is in a Swedish company, is a stealth company that we're currently building in-house.
All right, exciting. Jakob.
Good morning. My name is Jakob. I'm an investment director with Sunstone, a Danish venture fund based in Copenhagen. We have been around since 2007, investing in early stage biotech across Europe. We have done quite a few investments in Sweden historically, in Alligator Bioscience, in Cantargia, in Folicum. Also listed quite a few companies. It's been a while since we invested in Sweden the last time, but hopefully it's not too long. We are raising our next fund and hope that will be ready anytime soon so we can start investing in Sweden also again.
We're looking forward to that. Markus.
Hi, I'm Markus, Senior Associate at Hadean Ventures. Hadean Ventures is a Norwegian-Swedish life science venture fund. We started investing in 2018. My background is a PhD in oncology, and yeah, we are agnostic in terms of life science, so we do not only therapeutics, but also medical device diagnostics and digital health. And that also brings me to our last Swedish investment, which was Alex Therapeutics. That is a digital health company. But we have also done 2 deals in Lund and in total 4 or 5 Swedish companies.
That's a gold star right there. Thank you very much. So let me start by asking you the simple question. What does it take to attract investment from your fund? What are you looking for in a company or a project? Well, let's start with you, Markus.
In general, I guess the answer that always comes there is great innovation, great science, somewhat a uniqueness in terms of science or product. So we are usually very science-driven. So we believe that in terms of our investment focus and then also helping the companies, the science is the only thing we can't fix. So that needs to be in order, because there's not much we can do. With everything else we believe we can help. So I think it really boils down to a great innovation and solid science behind it.
So I guess high degree of innovation and something that stands out is always important. Jacob, what other factors do you look at when you decide if you're going to invest or not?
I mean, that is the key aspect of it initially. That is the science. We all VCs, I guess, life science VCs at least, are very scientifically driven. And that is the number one assessment we do initially, is the science. But of course, if that takes off, if the therapeutic benefit of the project takes off, then we start to look at the team, the financial plan, the financial risk, the IP, all the other tick boxes that we need to tick off. But the science needs to be good.
And Shamim, you and your partners then at HealthCap, how do you, when you talk amongst each other about a possible investment, what do you usually debate about? Pros and cons?
Yeah, I think that's a case-to-case basis. I think fundamentally we're all driven by seeing a patient benefit, but then it's complex, right? Because all patients need a treatment, and there are unmet medical needs everywhere in all diseases. So I think a lot of the conversations, usually when we look at early stage things, comes around, is it too early? Or how early can we invest in something? What's the inherent risk from a biological point of view, from a technical point of view, from a financial point of view? How does the long-term plan for an early stage company look like? And is that something that we're comfortable with all in all? So I think a lot of the debates, especially, it's in a way easier for later stage things that are more validated, either in another disease or from a safety perspective or from a disease biology perspective. But at the very early stages, it becomes a sort of a risk appetite kind of debate, and if we're comfortable bearing that risk or not.
Yeah. So Christer, what about that in your case? I mean, there's always the balance, risk, reward, and so on. But what makes you tick when you see something that you like? What is it usually that sort of catches your eye?
Yeah. So we are probably a little bit more risk averse than some of
Just
your.
a little bit closer. Thank you very much.
Do we hear me? No.
It's not.
Okay. So we're a little bit more risk adverse, I would say. So we kind of avoid the most fantastic deep science because either that means a new target, and the price tag of that, unless it's very early stage, is going to be super high, especially if the market is attractive. And we think the likelihood of success is, even though the science is brilliant, is quite low actually. Looking at all those fantastic new targets and new chemical entities, I mean, how many of these companies ever made it to an actual drug? Of course, in antibody therapies, that's quite likely, but for small molecules, I mean, that's so rare. And if we take sort of a view from the outside, from the investor perspective, LP's perspective, I mean, life science VCs have not returned so much money compared to tech VCs, and that's because the risks are so high. So we try to be very, very mindful of risks, meaning we actually like to do repurposing. We like drugs that has been in human before. We have a Japanese drug that's never been in Europe. We are trying it for new disease that are not doing in Japan. It's probably working fine in Japan, this drug, for this disease, but there's no incitement for it because it's a generics by now in Japan. It's an asthma drug. But here we can get, the full price, everything. It's considered new chemical entities. We knew the risk profile is zero. We knew it works well for certain diseases. We believe it works well for other diseases as well. So that's for us then a low risk, attractive case. Actually, one of the where we are co-investor with HealthCap in Oncorena is a similar case. I mean, this is a spider mushroom poison that been inhuman for, tragic reasons many times. And these people, they lose their kidneys. Every single cell in these kidneys, they die if they eat enough of this mushroom. But other tissues are healthy. No other tissues are damaged. I mean, it's amazing what evolution can do. And that means, we know that side effects are limited. But sure, both kidneys will die giving this drug. But that's again, it's a new, now it is a sort of new chemical entity, although it comes from nature. But it has a lot of either imperfections, but just the ability to potentially kill renal cancer and cure it. I mean, that's amazing to us. And we actually think the risk profile is quite low for that. Our latest investment, as you heard, is Din Psykolog. I mean, how many companies are there doing digital services for psychic illness? Hundreds of them across the world, or thousands. But then we look on the metric of these companies. It has a lower sort of customer acquisition value. It has a better lifetime retention. All the financial metrics looks great. It already has a turnover of, I don't know, 5 million euro or something. But it's attractive valuation, fantastic team. And that's maybe the last thing before I hand it over here. I mean, we are very mindful of teams here. Sometimes when it comes to pure pharma, biotech, teams are not, I mean, you can buy a team here because experience beats sort of intelligence in some sense in pharma. However, in tech and medtech, intelligence always beats experience. The smartest guys and women, the most driven ones, the most visionary ones, they will win, and they will create a winner in these cases. So here we are really, looking on the team, and we want, star teams for this. Otherwise, we won't do it. Actually, we even say this: unless we believe the founders can take this all the way, 10 years into the future, being in the leadership positions, we're not going to invest.
All right. Is that something you consider as well, Farzad, when you look at investments? The team, the founder, or whenever you look for a magic mushroom to exploit?
Yeah, I mean, I think we're pretty much all the same. I mean, in terms of the things that we look for in terms VC-wise, technology, team, return, so on and so on. So I think, I mean, from our perspective, when we get approached by cases, it's basically two things that we look for. One is value, and the other is risk. And kind of putting these two, assessing these two, balancing these two, and the third factor being the stage at which this case is in. Putting all those into the pot, as it were, and evaluating the case is, the way that we approach this. I think another factor actually is coming back to the team, if you like, is the extent to which they actually appreciate what they're setting out for. If they really realize what they're doing, if you like. And I think one of the things, one of the litmus tests that we use basically in that respect is to what extent, because obviously talking about technology, science, all that as well is good, but it's not actually science and technology that cure people, it's products. So I think, the extent to which they've actually appreciated, and not only that, actually, usually if they're early stage, I mean, the case will not be a product before 6, 7, maybe 8 years in the future. Will that case still be relevant and of value, clinically speaking? Has practice changed? I mean, so it has to be, something which withstands the test of time. And I was just to come back to the litmus test, is what we use is basically 3 letters, target product profile. Have they thought that through in terms of what their product, the profile of the product that they're working towards? Have they, and in a lot of cases they haven't. I mean, they're in love with the science and technology, but they haven't actually put any kind of envisionment into the product in the market, as it were.
Yeah, so balancing risk and reward is also something that's central, of course. I mean, we were speaking before the panel about having the question, why are you VCs so risk averse? I mean, you could argue that you wouldn't be VCs in life science if you were totally risk averse, I guess. But how do you sort of balance this risk reward thing when you look at investments? If I start with you, Jacob.
Yeah, so as I said before, we invest, I mean, what we invested in as life science VCs, I think, is, at least at Sunstone, is the translational risk, if you will, going from animals to patients. That is the number one risk. That is the risk we're willing to accept and invest in. Of course, we need as much evidence as we can in terms of animal data, human evidence, anecdotal data, maybe from patients on a specific target. So that risk we accept. Then, of course, we have all the other aspects, all the other contributors like financial risk, IP risk, team risk. These are things we try to reduce as much as possible. So at least in the companies I'm in, we have at every board meeting we have a list of a risk registry. Basically, we go through all the risk items. We say, okay, how can we mitigate this regulatory risk, this manufacturing risk, and we try at any time to reduce all other risk. So the number one risk is really the translational risk in the clinical trial.
Markus, how do you go about looking at the risks in Hadean?
Yeah, I think we have a pretty similar approach. I mean, I think especially the last year and a half have shown that surprisingly the bigger and bigger risk that is coming is financing risk, finding other VCs or investors that are willing to co-invest into both portfolio companies or new companies. So I think that is also why we see that, I mean, effectively rounds are getting bigger and bigger. And this is not because people want to throw more money at the science. It's just everyone wants to get more money in the first place to not have financing risk. Because, I mean, we all want our companies to succeed, and if they fail, they should fail because of science, translational risk, or similar things, but not because you have great science, but simply no one wants to fund it. So I think that is something that has really changed in the last 12 to 18 months, that it's more and more difficult to cover the financing risk. And let's see how the markets will change to that, but I think that's currently the biggest struggle for most VCs actually, to handle their financing risk.
But Hadean is also a little bit different, perhaps, the fact that you actually invest in public companies as well, listed companies. That must add a little bit to that risk, right?
Yeah, I mean, that is so we can invest in Nordic public companies, but we have also realized that being somewhat unique in that also creates the problem. Where do the co-investors come from? So that's a challenge, but of course also opens attractive opportunities, because if we look at listed Nordic companies, I mean, I think there's nearly no company that I think has a justifiable market cap from if you take level of innovation, stage, and all these factors. But I think there is a strong lack of life science specialist capital for these companies. And that is also an issue for us, because we would also not necessarily like to go in there alone, as we then run into this massive financing risk and risk the companies failing despite potentially having great science and a great product.
Yeah, that would be a shame. So, I mean, co-investors and finding those in this climate, which is arguably, everyone knows that it's tough right now. You mentioned, Kirsta, that you and HealthCap had co-invested. How do you feel about how much harder is it to find co-investors these days? What do you say, Shamim?
I think we talk to each other on a regular basis, and we share our incoming deal flow, we share our updates in our portfolio companies. Most of the times it feels like a timing question, rather than not finding someone who also thinks that that's interesting. Where are you in your fund? Is it, early in your fund, early stage company? Good, but we realize that there's a mismatch, which is good for the ecosystem, because then there are investors for all stages of companies. But that has been one of the challenges, I think, especially for early stage company creations. But we talk to each other, we discuss science with each other, we discuss companies with each other, we discuss ideas with each other. So there is a good network of both European, Nordic, and I'd say US-based investors, North America-based investors. So it's that we don't find each other. It's more of a, is it a good fit right now in our portfolio kind of situation, I would say. And then we sit on panels together and we talk afterwards and before, and yeah.
Jacob?
Yeah, I agree, because I mean, I don't know if everyone knows how collaborative, in particular, relatively smaller investors are. I mean, we work together as a team, basically, when we do the investments, and we share our thoughts and the strategy and the exit potential for the companies. So it's not like maybe you have more that want in the tech investments, where you have more competitions, you fight for the opportunities, you do them alone. That is definitely not the case, in at least not for the smaller to mid-sized VCs. We need to be collaborative, and we also like to have more brains around the table when we do the investments.
I spoke to one company CEO the other day who said that you need to have US investors in order to get the Nordic investors on board, because they won't lead otherwise. Is that true? What do you say, Christer?
Well, I think it depends on the size of this potential investment. I mean, what's the capital need of this company? So for the larger for the companies with the largest financial needs, I think that is true, because we simply don't have that capital in Nordics along the life science. I mean, there are of course European VCs, but there is a lack of venture capital as a whole in life science industry, especially in pharma. Medtech is better, and devices, but you know, in life science there is not so much money, and we have this shrinkage actually on the public list you're talking about. We have this anomaly in Sweden alone in the world, where we had 500 companies listed over the last 10 years on what's these names, the Spotlight and First North. And you know, these companies have an average decrease over the last 3 years of 93% in stock value. 93%. They were primarily invested by private individuals that, you know, felt pretty rich at one time when these 500 companies were high. They feel very poor now, so they are not supporting this company whatsoever. So many of these companies, some of them are good, actually go into liquidation or bankruptcy because of lack of investors. And the few VCs we have here, very few can invest in these companies. They are not allowed to. We have a small such mandate of some 20% to do that. And we are investing in those markets, so we are one of those that could invest with you. But that is an interesting market that's actually underserved right now, more in general than the entire life industry in Nordic, I would say. So there is a lack of money, and that's, you know, I think everyone here that is part of a company running pharma biotech development, I mean, you feel this. This is the worst time in 20 years to find capital. And in some way, it's good for the VCs, but it's not that good, because there's actually too few of us and there's too little money. So it's actually hard to even finance the good companies among ourselves. So our sort of approach to this is to be quite careful with which companies we enter. We don't really like to enter into those companies that has a huge financial needs. We like to be able to stay with the company all the way to some kind of, well, preferably approval. If we can do that and take a fairly big share of that capital to approval, then we feel confident that this will work for us. Otherwise, you know, there will be B rounds, and there will be C rounds, and there will be preference share classes and whatever. And at the end of the day, you might have zero for your early investments that were the riskiest ones. So there is also that game that has unfortunately played sometimes among VCs for, you know, for financial reasons. So I think, yeah, we have to acknowledge that there is a lack of money. There is not so many players in this here. As, you know, this is the majority of them in Nordics. There is maybe one or two more. And yeah, so it is tough for companies, but also for us, since we don't have enough total capital to finance good companies, especially the big ones.
Farzad, what's your experience then being in the Norwegian market then?
Right. Yeah, I mean, I think pretty much everything has been said here. I mean, it's hard times. Let's put it this way. But we kind of have gone into, you know, again, being very, very careful and cautious in terms of how we approach this. Precisely to not put good cases at risk, as it were, and not let them die because of this. So yeah, I mean, it's exactly the same sentiment as has been said. I don't have that much more to add. Basically, people have been saying, and I think coming back to this collaboration, I mean, amongst ourselves, I mean, we call ourselves the usual suspects. So it's like, this is it. Basically, we're not that many. Yeah.
Oh, we're happy that all of you are here today in the same room. So hopefully something good can come out of that as well. So the public market then, well, extremely challenging right now. And as far as, ways to exit or to get your returns, then the IPO market is quite dead, at least in the Nordics right now. What are your preferences when it comes to exiting or divesting your portfolio companies? Jakob, for example.
So we definitely always want to go for an M&A. I mean, that is the preferred option, and that's also why coming back to what you said, Krista, on the lower risk opportunities, maybe repurposing or reformulation. At Sunstone, we very much believe that you need the great science, the novel projects to be able to sell to an R&D head in a given pharma company. If it's already going to happen at a phase 2 stage, for example, or even phase 1 or preclinical stage. If we want to do that, we need the great science. We have shown in analysis, which you can find on our webpage, that if you do an IPO, then you postpone your exit at least 5 years. So from an investor perspective, early stage investor perspective, it's not beneficial or it's not attractive to go into an IPO, at least not from a timing perspective. But sometimes you need to do it. If you can't sell the company, you don't need to do it, basically.
Yeah. So can't help but thinking if that's the case, if you can't sell the company, then you ship it out to the public, general investors.
Yeah, that's the obvious question, and it's simply because then we need to do the next trial, and we don't have the financial capacity to, for example, to do a phase 3 trial. So that's why we need to raise more funding to do the phase 3 trial. It's certainly not because it's a bad asset. That's for sure.
No, not all companies on the stock market are bad. Like you said, also, Christer.
No, many are good. Many are good, of course.
Yeah.
I also think an important point, at least from our point of view, is that an IPO is not an exit. It's a financing strategy. So we don't necessarily exit the company once it's listed, but we see that as a financial round when a private round is not accessible, or when you realize that you can raise more money for your phase 3 on the public market. And there are specialist investors that do follow into that public IPO round. So it's not necessarily a transition from specialist investors to general investors once you go public. And I think that's a very important distinction to make. There are life science-based funds that do crossover rounds into IPOs to follow those companies too. So it's just to add to what Jacob was saying and to clarify what you were pointing out to, it's not a way of shipping off companies. It's a way of helping companies find a financial return that's sizable, or a financial strategy that's sizable for what's up next in the clinical development.
I understand, and I actually got an email yesterday saying you need to challenge the VCs. So, hence the poking the hornet's nest a little bit. Markus.
Yeah, but also, I mean, IPO, as that is, at least for VCs, usually the plan B. Plan A is M&A with pharma, and I think a really important factor for that is also that the companies themselves build a broad network with BD and pharma. They should do kind of the homework themselves. Pharma should know them, because in the end, deals usually happen not on the first time you meet the pharma company. Deals happen after they follow you 2-3 years, have met you, I don't know, 5-10 times, and then they feel now it's ready. So I think while we also have these contacts and we regularly pitch all our portfolio companies to the pharma representatives, it is in the end the companies that need to convince the pharma, because I mean we as VC have at least in pharma, from a pharma perspective, have a biased view on them. Of course, we believe it's a great asset, but it's the actual companies that need to do their homework and regularly interact with pharmas.
And we learned in the BD panel yesterday that patience is one of the superpowers you should have when you're doing BD work. Farzad, you have anything to add?
Yeah, I mean, we've experienced both. I mean, I think, but kind of rewinding a bit, I think talking about exits, I think kind of from a VC perspective, defining that. Obviously, you have M&A. There's an obvious definition of that. But I think also, I mean, from our perspective, and I think it was mentioned that listing is a financial tool, basically. I think in our experience, we've seen actually that again, coming back to something good science of value to the market, if you like. And when I say the market, what I mean is actually players who are looking at this segment, which means basically, huge funds, basically specialist funds, are also an element in this picture. And in our respect, we actually did a major case with one of our portfolio companies, a year ago, approximately a year and a half ago, where basically purely based on early stage data, the case basically got a huge financing round, basically because it was the market felt that there was a case to be had in terms of clinical value. So the point being that getting the prospect financed basically too far into the future for us was a good, it wasn't an exit, but it was basically as close as, if you like, to in terms of success, if you like, for taking a case forward. So and that has kind of been a stepping stone in terms of taking the case much out there, if you like, in terms of the various pharmas who are interested in this field, to kind of getting more noticed and so on. So, but I completely agree. I mean, it's basically the market listing is a. You should be careful. Let's put it this way: if you choose to go there.
Mm. So also in the BD panel, yesterday we talked about the pharma fashion show, or the fact that some things get into fashion a little bit. And now it's obesity, it's ADCs, and AI at some point. Are there any specific trends that you guys see, look at, and would like to tap into?
Let me comment on the public market, though, since you left me out.
Sorry.
So for us, we see the public market slightly different. I mean, today it is not a financial vehicle because those public markets actually have enormous struggle raising money. So it's not easy to raise money on public markets today, maybe even harder for many small companies. So that door is closed. However, companies that have revenues or approved products, they have fantastic time on the market today. You have Camurus growing like crazy, a repurposing company. You have Cantargia, a repurposing company that got a $2 billion exit. My own company, Equal Pharma, has a P number of 60. I mean, this is good times for companies that are growing rapidly with products that are ready in life science. This is fantastic. So, and that ties back to what we are thinking. You can't really do an IPO today unless the company's financial need in terms of risk finance is done with. If you have a phase 2B approvable product, then you can list it, for sure, because now it's about building the market. That the market will accept those risks. But taking a phase 3, especially since many of the phase 3 products that happen on the IPO markets, to be honest, were failures. I mean, the market is not going to pick those up unless there is another bull market, and that might be another 5-10 years. We don't know for pharma. Pharma is still, valued at less than half the cash position in US of the bigger biotech pharma companies that don't have revenues. So it's an extremely low valuation on off the market. So that's the reason there is no IPOs. There is no money in the public markets. However, if you have a product that is approved, IPO is still a viable option, in my opinion. And then whether or not this is an exit, well, that has to do with the liquidity and the size of the share. You know, this can definitely be an exit at companies exiting at 200-300 million euros, which is not a huge value, but that might be enough if this is an attractive stock. You can exit such a position if you own 10 to 15% over the course of 1 to 2 years.
Thank you for correcting me also. Looking back at the trend part then, how trend sensitive are you guys? Are you stick to your strategy at all times, or do you sort of lean towards where everyone else is leaning? What about you? Sorry, Farzad, you want to start?
Yeah, sure. So, I mean, I think I mentioned, so basically, I think when we get approached by cases, again, talking about risk and value, I think what is, obviously depending on the stage which they're at, and usually in our case, being an early stage investor, they are pretty much preclinical, and obviously, and very much technology heavy, science heavy. I think what's important is that it has to kind of withstand the test of time going forward, getting to the product, if you like. And I think in that respect, you know, what will be relevant and of value 7 years in the future, then you basically have to go back to first principles in terms of the fundamental clinical needs that will be at that time. And I think talking about fundamentals, I mean, in our case, we believe that immunology will always be relevant. It's just going to get more relevant. It has always been relevant, but it's just that the mapping has not completely been there. It's getting more and more in place. So I think in terms of the relevance of what is attractive, it goes pretty much back to the need and the approaches which are currently being worked on. So again, for our purposes, I think immunology is definitely one thing that we're always interested in. Gene therapies, I mean, they've been around forever. People have been kind of, it's always, it's just around the corner kind of thing. And I think immunology was pretty much there 15, 20 years ago also. I mean, people really believed in immunology. And today, I mean, you have the checkpoints and then the vaccines and so on. So I think, gene therapy is something which, but again, you have to position this in terms of what the need is. If the need is high enough, your risk willingness in terms of looking at the approach is also equally there. So, yeah.
And so you also need to distinguish between hype and actual evolution in things then. I know that you mentioned when we were prep talking about this panel, you mentioned biomarkers as something that is getting increasingly important when you look at things. What can you comment on that, Jacob?
Absolutely, because it's becoming even more and more difficult, as you also said, Krista, to get a drug approved with a novel target or novel mechanism. It's basically impossible if you look at it from the get-go. There's such a low probability. So I think increasingly we are looking at more and more, how can we get human evidence when we do the investment? As I said previously, like anecdotal data from patients or some genetic markers, or can we select the patients where we have a better probability of actually getting a therapeutic benefit? So I think that is at least one trend right now, that people are getting more and more focused on reducing the translational risk by using also biomarkers and patient selection, which is, at the end of the day, is also to the benefit of the patients, because you really get the right patient for the right drug.
So I'm just going to keep check of the time this time.
I mean, this is very important. I mean, yesterday was talk about health economics and the value, you know, the price tag and so on in terms of treatments. I think this is, I mean, biomarkers is definitely something that it's here to stay, basically, to improve on the clinical outcome and the health economics in treatments, as it were. So, yeah.
I remember in a panel in Stockholm that you were on, Shamim, there was someone else said, if you don't have a biomarker, don't bother. Is it that black and white?
Care to disagree with that. I think biomarkers are very important in diseases where there isn't much clinical precedence of a drug working for completely novel mechanisms, and where also, as Jacob was saying, for us to, in an early stage, evaluate if we think that this drug will work or not. For some diseases, you might not need biomarkers because your clinical trial readout is fairly short, so you will have an efficacy readout within a reasonable amount of time. But for bigger diseases, for diseases that has a slow trajectory of progression, Alzheimer's, Parkinson's, there might be important to find early signs of efficacy or target engagement or something else. So my point of view is not that you need a biomarker for everything. And I sometimes feel like early stage companies are really trying to find a biomarker where a biomarker is not a necessity. It's a nice add-on, it adds to the puzzle, but it's not a necessity, I would say. So it's a way to understand the biology of the disease when you're taking something preclinical into the clinic. And it adds to your, it's nice in a safety study to have some readout of efficacy, because those studies aren't necessarily designed to have a clinical effect, but if you can see a sign that, you know, this should later translate into an effect. And then we see with regulatory agencies that there are surrogate biomarkers that can be approvable, and then they're super important, I think. So it's important to understand what the use of that biomarker is for. It's not you have a biomarker, therefore you have a more attractive company. Is that biomarker adding value? Is it helping guide dosing, guide efficacy? So it's important to be mindful about what that biomarker serves.
Mm. Yes, Jacob.
Just a brief comment to that, because I also think biomarkers can help in the exit strategy, basically. If you look at the M&As that are happening, they're either happening at preclinical stage, where you're basically selling dreams of a drug, and then after the phase 1 study, very few transactions are actually happening, because many things are safe. So just proving something is safe is not worth much, honestly. And then at phase 2 again, when you go to patients, then you start to see M&A pick up again. But as a VC, and as I said, we really want to get as many transaction points as possible in the plan. So having a good biomarker that can at least sell some hope to the pharma company in the phase 1 study, for example, or maybe even a few patients in the phase 1 study, can really add another transaction point for the company.
So see that we are actually just a couple of minutes before the end. So I'd like to pick all of your brains one final time before we end, and ask that for investors who are looking to enter the life science space and try investing in it, what are the top 3 metrics that they should focus on when they assess a possible investment case? Can you give us the answers in like 30 seconds each? We'll start with you, Markus.
Well, I think first and foremost, you should have some idea or background in the field, because life science is really not a generalist field. You need to understand what you get into. And I leave a lot of things to comment for that for the others, but I also think a second thing is, if you see that something is a hype, as a VC, you're too late, because then everyone has seen it. You need to be ahead of the crowd.
Thank you.
Yeah, agree. If you see the hype, you're too late. I would say go with the fundamentals. Does it make a therapeutic difference, the project? And really focus on that. Then focus on the financial risk. Is there sufficient finance to drive the project until at least one, but preferably more, value inflection points? That is absolutely key.
Thank you. Shamim?
I agree with all of them, so to not be redundant, I think it's important to be mindful of valuations, and that's something that we didn't touch upon today, but early stage companies that are hyped tend to raise a lot of money because they can, but what value inflection does that money take them to? So it's easy to follow the hype in terms of valuation as well, but I think it's important to be mindful of what value is intrinsic to the company and what that financing round will generate in terms of value as well. So when you pick and choose about your investments. That's something that's utterly critical as well.
Thank you. Kirster, what's your best advice?
Well, I think you have to first understand what you're good at. If you consider investing in this sector, what are you actually understanding? And based on that, you see, so what does that mean? Do I actually understand, molecular mechanism or DNA or computational biology or something else in a fundamental way? And probably go for that. So I would say, niche yourself to the things where you actually have some kind of edge, because this is really hard to do. And if possible, go rather later than earlier. This earlier stage, unless there is, outside of pharma, biotech, other life science, medtech, I would kind of not do unless I had specialist knowledge.
Yeah, I mean, basically, again, I'm the last one, so pretty much everything has been said. But so, Shamim said innovation. So yeah, absolutely. I think, I mean, from our perspective, everything that's been said. But I would say the last thing, it was also very pertinent to us. We actually started with both medtech and pharma, but we cut out medtech because that was not our thing. And we basically have our full focus on, as I said, we're working on our fourth fund now, which is innovative medicines, precisely because there's so much risk involved that you really, really need to know, what you're doing. And yeah, so basically, again, going back to risk and value and being able to know, to judge that, when you go in.
I wonder if we have added any new life science investors by having this discussion, pointing out all the risks and how hard it is. But yeah, I guess we should also say the other side of the coin is that you can make a tremendous difference when you invest in this.
Yeah, and again, I mean, it is the lowest valuation on pre-revenue life science companies out there in 20 years. So that is actually a good reason to potentially invest in these companies.
Very good final words. I would like to thank you very much for coming today and for taking the time. And please hang around, and I'm sure people will ask you stuff when you are circling around in the area. So thank you very much, and give them a warm hand.